Hi, I'm Jimmy. In this video, we're looking at the US economy. We're using a few different economic indicators to see if we can objectively gauge where the economy stands today and ultimately try to answer the question, should we invest now or should we wait for the market to pull back to a more reasonable level? Okay, now before we jump in, I just want to let everybody know that I recently launched a second YouTube channel called Learn to Invest Shorts, and as you might have guessed, that's where we're publishing a bunch of YouTube short videos. So videos that are less than 60 seconds. And we're gonna focus mostly on doing quick company valuations where we try to calculate the fair value for different companies, usually using discounted free cash flow, but that only works with some companies, so really we'll use whatever method is most appropriate for different companies. Then we may also do some quick news updates, something if it's really newsworthy and is worthy of a video, and maybe we'll try to come up with some broad learn to invest topics that frankly we could cover in 60 seconds. So if you can, please go check out that channel and hit the subscribe button, watch some of the videos, let me know what companies you think we should analyze over there. Okay, now let's jump in for real. So our first economic indicator is consumer confidence. Now ultimately, what we're trying to do with this chart is we're trying to take a look at the big picture. In this case, the big picture goes back about 20 years. And then we're gonna try to identify what the more recent trend is within that bigger picture. So in my mind, the recent trend looks like it is in fact moving higher, although it is below where we were before the economy began to struggle in 2020. So I think it makes sense to keep this point as a neutral point. So right now, over on our scorecard, we get a point for the bulls and a point for the bears. So that's a neutral point. Okay, our next economic indicator is looking at household debt. And we can see that during 2020, well, there was a big pop in household debt, which makes sense. But then debt started to head lower, but did stall out a bit. Now, in an ideal economic indicator situation, well, what would have happened is we would have had a pop because of what happened last year. And then as things began to fall, in theory, it should have recovered all the way back to previous levels. That could take a little bit of time. So I think it's more reasonable to assume that it's going to take a while to return to pre-2020 levels, which if that's the case, that means that this would really be a point for the bears, since increased debt is a negative sign for the overall economy. Okay, now we've got another debt-related economic indicator. This one is a measure of what percentage of people are 90 days or more late on their credit card payments. Now, I think it's probably clear to most of us that this is going to be a point for the bears, since this was already heading in the wrong direction. And then last year only ramped up the situation even more. So over on our scorecard here, well, now we've got 2 points for the bears because of the debt situation. Okay, now we're shifting over to the Treasury yield curve. So the yield curve ultimately plots out what an interest rate is, in this case, what interest rate US Treasuries are at different maturity dates. And the key here is the shape of this. This upward sloping shape is exactly what we want to see. It's exactly what it's supposed to look like. And this is logical if we think about it, because we would expect if we were investing for 30 years, we would expect to earn a higher interest rate than if we were investing for, let's say, just 3 months. So this yield curve is going to be a point for the bulls. Now, I should also point out that in our last monthly review of our economic indicators, well, I mentioned that we shouldn't really just take one point in time for the yield curve. Because in theory, if it inverted yield curve is where the short-term rates are higher than long-term rates. If it did in fact invert, well, that it could invert this month and then 6 months later you could end up with a recession. So as we flip through these months, well, we can see that the shape of the yield curve has been fairly good for a while. So this confirms that this is going to be a point for the bulls. Now we should recognize that the yield curve is actually getting steeper, which means that interest rate spreads are getting higher. That's the difference between short-term rates and longer-term rates. They're widening. Now, just as a quick side note, when we see how this steepening is happening or the widening is happening, well, banks tend to perform fairly well. They tend to borrow money at short-term rates and lend out money at long-term rates. So a steepening yield curve could lead to higher profits for banks. Just something for us to consider. That could be an interesting industry to look closer at. Either way, over on our scorecard here, well, the yield curve gives us our first point for the bulls. Okay, now we're shifting over to the job situation. Our first economic indicator is jobless claims. And clearly, these jobless claims numbers, these recent jobless claims numbers, are still way above where they need to be before 2020 happened. It does appear that the recent trend is heading in the right direction, But either way, it's still higher than it should be. So this is going to be a point for the bears. Okay, now along the same lines, now we've got the unemployment rate. Now, I've had unemployment as a neutral point since it does appear to be improving, or at least heading in the right direction. But the most recent number was in fact a minor uptick from the previous month. Now, I don't want to overreact to one single number. I just think it's worth noting that there was a slight uptick, but we'll have to see what happens in coming months. So, over on our scorecard here, well, we have a neutral point for unemployment, and we have a bearish point for jobless claims. Okay, now we're going to shift over to housing. So our first economic indicator is the average price of existing home sales. And we can see that this is in fact trending higher. It has been for a while, which according to many, call it economic textbooks, would point this to be a positive sign for the overall economy. The more equity homeowners have, in theory, the more spending that could happen, the better the economy would do. But what if we're trying to buy a home or even rent a home? Well, if we are, then this jump in housing prices, this continued increase in the price of houses is likely to be a bad sign, since it's going to be tougher and tougher for more people to get into houses. So I think the real question is, how high is too high for home prices? I assume that the ramp up in home prices won't go on forever. And even if we don't see a drop in the price of houses, it is possible that home prices slow their growth so they don't go up as fast, or even they turn sideways for a bit. Maybe the average price just sort of levels off as the rest of the economy catches up to it. So over on our scorecard here, well, I think it makes sense to keep this one as a neutral point, since rising home prices I could easily make a case in either direction, depending on what our personal situation is. And then our next housing economic indicator is housing starts. Now, housing starts measure the amount of new homes being built. Now, interestingly, this is going to be a point for the bulls, since more houses being built creates more jobs, and this actually helps offset the problem that we could be facing with the pricing of houses. And that's because home builders essentially provide this additional supply the more houses that are being built. If they suddenly built a ton of houses all at once, well, there would be an oversupply and prices would either drop or at least stay still. So more houses being built generally puts downward pressure on the price of houses. Assuming, of course, that more houses are being built than there are people looking for houses. Okay, so over on our scorecard, well, we got a neutral point for housing prices, and housing starts gets a point for the bulls. Okay, now let's have a look at manufacturing. So this is the ISM Manufacturing Economic Indicator. And basically, the way that this economic indicator works is anything above 50 implies growth in the manufacturing sector. Anything below 50 implies negative growth. And as we can see, right now we're at about 60. So this is clearly a good sign for manufacturing. Now, I was curious how the level of 60 compares to the longer history. And I was able to get data for this indicator going back the past 70 years. And clearly we can see here that the level of 60s is on the higher end historically over the past 70 years. So overall, this is a very positive sign for today's economy. So back to our scorecard now. Well, now we have a point for the bulls within manufacturing. Okay, now anybody who knows me, has been following this channel for a while, knows that my answer to the question, invest now or wait, my answer tends to be to either invest consistently with something like dollar cost averaging, or strategically and patiently invest. And while I agree that broadly speaking, the stock market is overvalued, that doesn't mean that all companies are overvalued. One of the advantages that I've personally found from launching the new Learn to Invest Shorts channel is that we get to look at so many different companies, and much to my surprise, I've actually come across a handful of companies that currently look to be undervalued based on discounted free cash flow. So if we find companies that we like and they happen to be undervalued, then I think it makes a ton of sense to jump in and try to buy those stocks as soon as we can, as soon as we have a good idea of the bigger picture. I think it makes no sense to try to time the top or the bottom of the stock market. Instead, just keep looking for good companies at good prices. Now, if you're curious which companies could be undervalued, well, like I said, I've got a whole bunch of short videos which allow us to go through them fairly quickly on the new YouTube channel. So if you can, please go check out that new channel, check out the videos, let me know what companies you want me to try to come up with a fair value for. I've got a link right here to the new channel. I got a link in the description below. Thank you, and I'll see you in the next video.